All right, welcome back everyone for another deep dive. Today we're unpacking a really interesting, maybe even a bit provocative report. It's from the Macro Butler, titled Chaos, Politics, and Instability: The Real CPI Driving the Business Cycle. So our plan is to really get into this report, cut through some of the noise, pull out the key insights, and try to understand what it's actually arguing, and importantly, what it might mean for you, especially if you're thinking about investments. Because yeah, this isn't your typical dry economics paper. It definitely connects some dots between data, markets, and yes, even politics in ways that might surprise you. Let's jump in. So the report starts right off with the latest CPI numbers for May. What did those figures look like, and what did the report find interesting there?
Right. So the report notes the headline CPI number for May. Month over month, it was up 0.1%. That was actually a bit shy of the 0.2% forecast. Year over year, though, it landed at 2.4%, which matched expectations. A small increase from April's 2.3%.
Okay, so slightly softer month on month, but ticking up yearly. What about the pieces inside that number?
Yeah, digging in, the report points out a few things. Energy, they said, was still acting like a, quote, deflation superhero, helping keep the overall number down. Goods prices, still in what they call the deflationary gloom.
Mm.
But food prices bounced back a bit. And services, which is a huge chunk of the index, saw their biggest monthly jump since February last year. So yeah, bit of a mixed bag under the surface.
Okay, so headline maybe look decent, but underneath some definite pressures, especially in services. What about core CPI? You know, the one stripping out food and energy the Fed supposedly watches closely.
Exactly. And core CPI, month over month, was also softer than predicted, came in at just 0.1%. The forecast was more like 0.3%, and it was softer than April's 0.2% as well. Year over year, core CPI hit 2.8%. That was right on target with expectations, and the report called it the lowest since March.
Lowest since March. Okay. Does the report break down the core components further?
It does. Core services, that's like 76% of the whole index, actually softened just a tiny bit year over year. But here's the kicker, the surprising part. Core goods were actually inflationary for the second month in a row. And the report adds this detail. May marked the 60th consecutive month that's 5 years of rising core CPI.
Wow. 5 straight years. 60 months. That really puts the focus on slightly softer monthly numbers into perspective, doesn't it?
It really does.
And speaking of perspective, the report seems to take aim at this whole inflation is totally over narrative that's been floating around. How does it tackle that?
Yeah, it acknowledges where that idea comes from, mainly from owner's equivalent rent, or OER, the imputed cost of shelter for homeowners, a big CPI component. And the report notes, yeah, OER did slow a bit in May, down to 4.2% year over year from 4.3%. That's the coolest it's been since early 2022.
Okay, so there's the glimmer of hope, the thing people point to.
Right. But then the report just pivots hard. It says, basically, this only looks like inflation is beaten as long as you squint, tilt your head, and ignore rent, food, and reality. It's pretty blunt. They're saying you're kind of missing the point,
Right.
or maybe choosing to ignore the sticky parts.
Okay, not mincing words. Do they look at other measures like supercore?
They do. Supercore CPI, that's core inflation minus housing, food, and energy, trying to get at underlying services, the report highlights that it actually climbed in May. It went up to 2.86% year over year. That's up from April, back to where it was in March. And the report explicitly connects this rise to, quote, the world getting terrified. They see this as the impact of recent trade policy showing up now. So from their perspective, this directly contradicts any kind of victory lap on inflation.
Okay, terrified. So the report is drawing a really clear line connecting policy, specifically tariffs, to what they see driving inflation right now. Let's unpack that argument a bit more.
Yeah, this is kind of the core thesis. They argue the May data is the first full month reflecting these recent tariff actions rippling through. They dismiss that dip back in March as just a statistical burp, like a one-off anomaly. Their point is, this tariff tax, someone has to pay it. Either businesses eat the cost, or, more likely, consumers see higher prices.
So it's not just abstract economic forces in their view, but deliberate policy pushing prices up.
That's exactly the argument. They even coin a phrase for it, the Trump reflation era.
Sure.
Suggesting these trade policies, intentionally or not, are kicking off a new round of price increases. They point to their own broad inflation measure, the U.S. Umbrella Inflation Index, saying it's crept up to 3.28% year over year. And from where they sit, that makes the Fed's magical 2% target look like, their words again, a phantasmagorical illusion, basically a fantasy in the current environment.
A phantasmagorical illusion. Strong stuff. Does the report try to quantify how far off that 2% target might be? Any math behind that claim?
Oh yeah, they get into the math, they use base effects, how today's numbers compare to 12 months ago. So their calculation is to actually hit 2% CPI by the end of 2025. You'd need monthly CPI prints consistently below 0.1% for the rest of this year and next. They call that scenario a statistical unicorn. Basically, highly improbable.
A statistical unicorn. Okay, so not likely. What if prints are higher?
Well, their math suggests if monthly prints stay around 0.2% or higher,
Yeah.
which is closer to what we've seen recently, then year-end CPI could land somewhere between 2.6% and potentially as high as 5.5%.
Wow, 5.5% is a long way from 2%.
It is. And this leads the report to kind of question central bank policy. They suggest maybe easing policy during what they see as an inflationary boom wasn't exactly a masterclass, perhaps hinting at, other pressures influencing decisions. They keep coming back to their core inflation drivers, shortages, strong demand, and this crucial one, fading trust in public institutions. And they argue that tariffs, trade wars, and what they rather dramatically call U.S. imperial chest thumping just fuel all three of those things. Their bottom line, rising policy chaos equals rising CPI. They even show a chart correlating inflation with the U.S. Economic Policy Uncertainty Index.
That link between policy uncertainty and the economy is really interesting. How does the report say this uncertainty, this sort of chaos, actually affects businesses and people beyond just inflation numbers?
So, according to the report, when uncertainty gets high, especially policy uncertainty, business owners get nervous. They tend to slam the brakes on hiring new people and also on capital expenditures, investing in new equipment, factories, that sort of thing.
Okay, so businesses pull back. What happens then?
Then the report argues you see reduced spending overall, maybe some creeping layoffs start, and this directly leads to a jump in the misery index.
The misery index. Remind us what that is again.
It's usually just the unemployment rate added to the inflation rate. Simple but telling. So if inflation stays stubbornly high and unemployment starts to tick up because businesses are cautious, well, misery rises. The report makes the point that this rising uncertainty isn't just about bad feelings or low confidence. It creates a real full-blown economic hangover. They show a connection, a correlation, between that uncertainty index and the misery index, suggesting they move together.
An economic hangover driven by uncertainty. Okay, so if we follow the report's logic, stickier inflation fueled by policy chaos, what does it suggest investors like you should do about it? How should you position your portfolio?
Right. This is where they offer some pretty specific, actionable ideas. They argue for a serious look at your asset allocation. They bring up the permanent portfolio concept, the idea of a mix designed for any weather. And they observe that in this kind of environment where trust is maybe eroding, things they call contracts like bonds and cash, basically government IOUs tend to underperform property, which includes stocks and gold. Why? Because if trust in the issuer, the government, goes down, the value of their promises, their IOUs, also goes down in people's eyes.
Okay, so contracts underperform property. What specifically does well then?
Gold, they say, is expected to outperform bonds and cash when uncertainty spikes. They get pretty tactical after that. They suggest growth stocks, the darlings of the low inflation era, could flop. They point to the NASDAQ in 2022 as an example. Instead, they lean towards indices like the Dow over the NASDAQ. They like energy producers, companies benefiting from higher energy costs, more than tech companies that use a lot of energy. And just broadly, they prefer real assets, tangible things like gold, silver, commodities, maybe certain real estate, over what they call the empty promises of untrustworthy governments.
Okay, real assets over promises. What about the consumer? How does this affect consumer stocks?
They expect consumer stocks, especially discretionary ones, to take a hit. As budgets get squeezed by inflation, they see shoppers trading down, swapping, quote, high-end items for actual food. So naturally, they favor consumer staples companies selling necessities over consumer discretionary, the non-essentials. They specifically mention Walmart potentially outshining the luxury sector, arguing that everyday low prices become a kind of luxury themselves when money is tight.
Interesting point. What about bonds and cash management?
On bonds, they're pretty clear. Avoid long-dated government bonds. They frame holding them as basically subsidizing government spending you might not trust. For cash, they suggest keeping it short-term and high quality. Think investment-grade corporate bonds maturing in under 12 months. You're lending to solid companies, but only for a short period. And a really key recommendation, allocate a significant chunk, they say over 25%, to physical gold, silver, and hard commodities. They call this anti-fragile protection.
Anti-fragile protection. I like that. The idea that it doesn't just survive chaos, but maybe even benefits from it. Now, you mentioned the report touches on politics, which is unusual. Again, just to stress, we're relaying the interpretations from this specific report. What's their take on the political side of this chaos?
Yeah, it's definitely a distinct part of the report. They frame some of the recent political back and forth not just as random chaos, but possibly as deliberate choreography. They interpret certain public feuds using some pretty colorful labels like manipulator in chief and tech gig Rasputin as being part of an AI turf war. And the report connects these dynamics to specific people, figures like Peter Thiel, J.D. Vance, and an ideology they link to Curtis Yarvin's Dark Enlightenment ideas.
Okay, so they're mapping out specific actors and philosophies they see behind the scenes.
According to the report, yes, it quotes Vance supposedly saying things like, fire every single mid-level bureaucrat,
Yeah.
replace them with our people.
Like what?
But the report's interpretation isn't that this is about draining the swamp for the public good. Their claim is it's about restaffing it to benefit what they term the PayPal mafia.
Hmm.
So the report's conclusion on this is quite pointed. It's choreography, not chaos. And the political messaging might be populist, but the actions, they argue, favor plutocracy benefiting tech oligarchs. Again, really important, this is the analysis within the source report itself.
Understood. Definitely a specific and charged viewpoint presented there. Stepping back to the broader economy, what else does the report say? Did it touch on things like the trade deficit?
It did, briefly. It argued the U.S. trade deficit isn't really just about China, but reflects a deeper, longer-term issue. The U.S. becoming, in their words, a consumption-addicted debtor state since World War II. The report sort of laments what it sees as a gap between what the U.S. economy needs, deregulation, tax reform, fiscal discipline, and what's actually happening, which they characterize as politicians focusing on managing portfolios or enacting policies like tariffs. It includes a pretty stark warning. Empires in decline tend to self-implode under the weight of war, debt, and delusion.
Oof, that's a heavy warning. So what's their ultimate prediction for in-Trump reflation now? Where does it lead?
Their prediction is that this reflationary period eventually morphs into Trump's stagflation. So it's still high inflation, but now combined with an economic slowdown or bust, an inflationary bust. And stagflation, they warn, is painful. It means people end up buying even less for even more.
And in that stagflation scenario, what's the asset play according to them?
Gold, again, they highlight it as the only anti-fragile asset in that kind of environment. Both gold and silver are framed as this eternal hedge against collective stupidity and government hegemony.
Hmm.
They even mention a technical indicator, the S&P 500 to gold ratio, suggesting it might be signaling a potential shift towards stagflation within the next, say, 6 to 9 months. The report really hammers this final thought. Collapsing public confidence driven by political instability or wars inevitably leads to economic turmoil. And trade wars, despite any rhetoric about winning or retaliation, ultimately just hurt the economies involved.
Well, that was certainly quite the journey through a report that connects a lot of dots. CPI, tariffs, policy uncertainty, investor strategy, even deep political commentary. We've touched on the nuances they see in the inflation data, their core argument about tariffs and chaos driving prices now, the link to broader economic pain via uncertainty, and those specific investment ideas favoring hard assets, certain stocks, avoiding long bonds, and of course, that very specific take on the political dynamics potentially fueling the fire. It's definitely a distinct lens this report offers, highly opinionated for sure, but aiming to provide a framework and maybe some actionable thoughts for navigating what feels like a pretty complex time. It really makes you think about the downstream effects of policy choices and instability. So maybe the final thought to leave you with today, inspired by this source material, is this. If, and it's a big if based on this report's premise, if political uncertainty and eroding public trust really are fundamental drivers of inflation and economic stress, how do you build resilience? Not just in your portfolio with things like gold or staples, but maybe more broadly in life itself when those foundations of policy and predictability seem, well, less predictable. Something to ponder as you look ahead. Thanks for joining us on this deep dive.